Hi everyone, I'm Shawn Severson, CEO and Head of Market and Thematic Research at Water Tower Research. Welcome to this week's summary of our weekly commentary for the week of August 10th. Before I get into the 5 things that drove the week, let me start where it counts, with what to actually do with it. 3 reads to carry into the week. First, we're staying with the profitable, higher quality end of the market and in small caps that still means the earners and value names ahead of the speculative growth end. The price ran the other way last week, but the reported numbers didn't back it up. Second, we're not paying up at the top. Estimate breadth is the best it's been all cycle, but the premium on the biggest names is also the widest it's been, so we'd rather let this week's inflation data clear than chase it. And third, what would change our mind? 4 things, any one of them alone. The labor weakness becoming a trend and showing up in spending, a 10-year grinding toward 5% on real yields, the revisions rolling over, or credit spreads widening disorderly. Okay, here's the why behind all of it. Number 1, the labor market cracked and the headline hides it. Payrolls fell by 23,000 against 95,000 expected, and May got revised down to 63,000. The unemployment rate actually improved to 4.1%, but for the wrong reason. More than 260,000 people left the workforce. That's people giving up looking. And wage growth slowed to 3.2%, the softest in 5 years. 1 month isn't a trend, but it's the first real demand warning of this cycle, and it moves us a step closer to concern. Number 2, the companies that reported split the economy in 2. Caterpillar put up the first $20 billion quarter in its history, revenue up 24%, and its backlog, orders it hasn't filled yet, hit a record $72 billion, up 92%. That's the AI build-out turning into real industrial revenue. Now the other side. McDonald's comparable sales rose 0.8%, but guest counts were negative, so price carried the quarter and traffic fell. Kraft Heinz and Molson Coors both shrank, and the trade desk guided next quarter down about 12%, pointing at packaged goods and autos. Advertising is one of the first things companies cut when they see weaker demand coming. Number 3, quality won again on the hard numbers, and the market bought the opposite. 82% of S&P 500 companies beat, stepping down the cap stack to about 57% in microcaps. And here's the figure that needs no analyst estimate. More than half of that microcap group lost money in the quarter. Yet microcaps led the market last week, up better than 6%, while the profitable small cap screen managed about 2.5%. Number 4. Rates finally gave the rotation what it's wanted, and the reason isn't comforting. The 2-year fell to 4.19% and the 10-year to 4.65%. That's the relief the broadening has waited on since June. But it showed up because growth is cooling, not because inflation got beaten. Number 5. This week the inflation data and the shopper decided. July CPI lands Wednesday morning, Treasury sells the 10-year that afternoon, and the 30-year Thursday, and there are no Fed speakers all week. Friday brings retail sales, the first read on spending since payrolls went negative, with a run of consumer companies reporting into it. On the earnings side, Cisco and Applied Materials tell us whether the AI order book is reaching the middle of the supply chain. Labor gave us the warning. Consumption decides whether it matters. And before I let you go, a quick lightning round from our quick read, the 1-page summary up front. On valuation, the Magnificent Seven now trade near 24.5 times earnings against about 21 for everybody else. And that gap tripled in a week. Crypto rose with everything else, the Bitcoin funds taking in roughly $490 million after outflows the week before. And gold was up almost 8% with silver more than 11%, really a bet on lower rates, while oil fell more than 10% back toward its futures curve. That's the week, the read up top, and the 5 things behind it. I'm Shawn Severson with Water Tower Research. Thanks for listening, and I'll see you next week.